what happens if they actually need this money sooner, right? What if they run into some issue and they need the money? Welcome in everybody to REI Tax University. If you are a real estate professional or investor, or you've ever wanted to know more about how to use real estate to offset your taxes and keep more of your own money, you are in the right spot, and I appreciate you being here. Now let's dive into one of my favorite topics, which is utilizing a Roth IRA for your kids to set them up for life with tax-free retirement income. So let's start with, why would you do it? Well, every year, each person can put in the max contributions to the IRAs. And if you meet the requirements, you can do it to a Roth IRA. So for this child, they can likely put in the max contributions to the Roth IRA. Now they have to earn. They can only put in as much as they earn. So if they earn in 2025, the max contributions is $7,000. If they earn at least $7,000, they can put $7,000 into the Roth IRA. That money is going to go in there and it's going to grow tax-free. It's going to be invested. It's going to grow every year tax-free. If they wait and take that out in retirement, they can take it out. Distributions will be tax-free. There are no RMDs, no required minimum distributions. So there's no point where the IRS is going to say, hey, you have to take that money out. So they can essentially control that money when they get to retirement of saying, okay, we want some more money this year and we can take it out of this Roth without having any tax hit, right? So if a child from the ages of about 12 to 18 years old puts in that $7,000 a year, that's a $42,000 investment. If it grows at a rate of 7% rate of return and they don't touch the money, they don't put another dollar in after they turn 18. They never fund their retirement account their whole life, and they turn 65 plus and they want to take that money out, that balance is going to be over $1 million, right? And they're taking that money out tax-free. It's not showing up as taxable income on their tax return. They can take it out, they can use it for whatever they want to use it for, and there's no tax hit to them. So for a $42,000 investment, they have over $1 million of tax-free income. They never paid tax on that money in their whole life, right? You paid them out as wages and you did it effectively so that there was no taxes on when you paid them as your child, and then they grew it and they took it out tax-free. Now, but here's the question, what happens if they actually need this money sooner, right? What if they run into some issue and they need the money? Well, the beauty of the Roth is that because there is no tax break when you put the money in, and as the child, they don't need it because they don't have a tax hit already, so they're not trying to reduce their tax hit in those early years, they can then take out any money that they've contributed tax-free. So if their balance is at $500,000 and they need to take some of that money out, they can take it out tax-free. It'll just stop growing. Now, if they dive into the earnings of this money, they're going to start to have to pay taxes on that. And if they do it before 65 and not for a qualified reason, they could be paying a 10% penalty on it. So we wouldn't suggest that. But there are some exceptions to where they can take out both the contributions and the earnings for a qualified exemption. So some of these qualified exemptions include first-time home buying, birth or adoption expenses. There's limits on a lot of how much they can take out for these types of things, but they can take it out. Qualified secondary, so college tuition and fees, right? They can take it out for school there. So these are reasons that they could take money out of their Roth, both contributions and earnings, tax-free and without a 10% penalty hit. Also, death is another thing. So if they pass away, then whoever that Roth is left to can take it out tax-free without the penalty. So hopefully that helped provide a little bit more insights onto the benefits of using Roth and how to actually do it. It's really not that complicated to get set up and rolling with. If you can get your kid paid, if they can get earning some money, this is an incredible strategy to use when they're young, to use even in their college age years. And then you've also set them up to understand the benefits and the time value money and everything that they're earning there and how to keep using that in the future. So we talked about an example if they just put the money in from 12 to 18 and never put another dollar in. But if you set them up right, they're going to continue building that and growing it. They can move it over. They can self-direct it. If they get into real estate or they want to get into something alternative with it, like there's all kinds of things they can do here utilizing the Roth IRA effectively. Guys, if you found this video useful or you can get some tidbits of it, I'm super thankful. I invite you over to our community, reitaxu.com, where at REI Tax University, we talk all things tax planning for real estate investors and professionals. So I invite you over there, join the community, start to get active on our forums, join in on our office hours and our case studies, dive through our video series. We've got entity structuring, depreciation, all kinds of other things that we deep dive through, provide the resources to that so that you can use them to offset taxes, reduce your liability, really do so legally as you captain your own ship here, and know that you're in the best spot as a real estate investor or professional to reduce your taxes overall. Appreciate it, guys.